Welcome back for another Market Snapshot. We hope you're having an incredible summer because it is summer and I'm sure you're feeling the heat. And Ruben, what are we going to talk about today?
So we're going to go through our, basic summary of the statistics that came out over the last couple of weeks. We'll talk about home sales, we'll talk about mortgage rates. Then we're going to answer some questions that we got from, our audience.
Gotcha. I'm excited for those questions. So let's really dive into what we typically talk about, our numbers. What's going on in the environment right now?
Yeah, so home sales are still slow. Not really a lot of change from last month. 4.1 million sales in May, down 2.8% from last year. Interestingly, we're seeing like a lot of kind of divergence, there's a lot of different markets out there right now.
Right.
Whereas, sales are down the most in the South at 5%. They're down a little bit less elsewhere, only about 1% in the West. They're down about 4% in the Northeast. So a little bit of dichotomy. Same thing when we get into prices. Prices were up across the country about 6%, 5.8 this last month.
Wow.
Right, we hit an all-time high again in median price. At some point, I think we really need to come to terms with the fact that what we have is like a housing shortage.
Right.
Right,
even without all of the typical demand we would see.
Exactly.
We still have a shortage. I think that's something missed by a lot of people.
Yeah, and I think we're going to have to eventually do something to address that.
Sure.
So, aside from that, looking at prices across the country, Northeast 9%.
Wow.
So you can really see where the inventory differences are.
Sure.
Whereas the South was only about 3.6%. So there's a pretty good dichotomy across geographies right now on what's happening with inventory. And a lot of it's probably still shaking out from the patterns that we saw during the pandemic of people moving, where the construction was happening, and all that sort of exactly kind of evening out now with the market tightening up.
Sure. So just to hit on that really quick, we're still seeing lower sales, but higher prices pretty much across the country, just differentiation in how much of either or based on where you're at. And you mentioned the Northeast. I have to say this is one of the key reasons why we tell people all the time they need to talk to somebody local to them, because if prices are 9% higher in the Northeast, but really not that much different in the South, you really have to know what's happening and why and how all of that works together, because we also have that sticky fun thing called the Fed and the interest rates that really intervene in the conversation in different ways based on the inventory and the pricing.
Yeah, that's exactly right. Affordability right now is definitely varying across the country. You need to be looking locally to understand what the situation is. The national story isn't going to tell you everything.
Right.
In terms of inventory, up 19% across the country right now. 1.3 million homes were for sale at the end of the month, 3.7 months of inventory. Even with inventory coming up to where it has, price is still going up, right? So it's not enough.
Yeah.
So that tells you where we're coming from and how low inventory was coming into this, that even though we've seen, inventory go from, it was around just a little under 900,000 homes at the end of 21. Now we're at 1.3 million, yet still seeing 6% price increases.
Yeah. What I think is really interesting about that is a lot of it goes back into the conversation you were having with our viewers a few months ago. We're not seeing the loosening up of the inventory because sellers also have to figure out where they're going next, and they're not excited about leaving those really low interest rates they likely have.
Yeah, that's exactly right. The lock-in effect is still there. We have seen some more movement in mortgage applications when rates move around, so that's a good sign.
Sure.
But in terms of on aggregate, in mass, we're really not seeing much change yet. It's really going to take some time. And that time won't be measured in months. Probably it'll be a couple of years, I think, before we really see movement. Speaking of rates, we peaked in early May, first week of May, basically around 7.3% as a weekly average.
Wow.
On a daily basis, we hit almost 7.5 at one point. Right now, we're about 6.9. So we made progress down. Treasury markets have been coming down a bit, which is helping us as well.
Sure.
But most forecasts, like I just said, we're looking at a very slow march over the next couple of years.
So I think that's really important for people to understand, because what I'm still hearing that hasn't changed really all year so far, talking to you about these numbers and what it means, we still have low inventory. We still have a decent amount of buyers out there looking to buy compared to the inventory we have available, which means prices are still going up. And that's not changing. Neither is the roundabout averages of where we are in our mortgage rates, right?
Yeah, affordability is going to be a challenge for at least the next couple of years, and some of that's going to depend on whether any actions get taken to address it or not. The economy's still doing well, right? GDP's been healthy, unemployment's still really low, people have jobs, people have incomes.
Yeah.
We're still dealing with the after effects of inflation. That's going to take a while for people to adjust to, for incomes to adjust to,
Sure.
but it is happening, and inflation's been slowing down. The last inflation report that came out was pretty solid, which is kind of segueing us into our first question, right?
Yeah, absolutely. So let's dive into it. The first one is from Kathy, and she asks, what is the Fed planning and when is the next predicted change in rates?
Yeah, so right now, the forecast is basically for one rate decrease this year. Most likely
One
happening.
is better than none.
Yes. Most likely happening in November or December, and it'll be probably 1/4 of a point that it'll come down.
Which does not equal 1/4 of a point in our actual mortgage rates, just to be clear for the viewers, right?
It may come pretty close. This is the first move, but what will likely happen is it becomes more certain the Fed will move after these meetings and language changes, is you'll see interest rates just kind of slowly trend down ahead of the meeting versus, the meeting gets announced and then rates drop 1/4 of a point. That's typically not how it works. People anticipate, markets anticipate. The more certain it becomes, the more the actual active rate will reflect the future versus, waiting and having like a big change.
Sure.
Another question related to the Fed we had was just kind of like, do we think they're going to hit the soft landing, right?
And what does that mean?
What does it mean? For me, it mostly just means, does this lead to a recession? So right now, looking at everything, it seems like so far so good. Right. We don't know. We can't predict the future.
Sure.
The longer the Fed keeps rates high, the risk right now is they keep them high for too long, right? Mm-hmm. At least in terms of the soft landing conversation. If they keep it too high for too long, it hurts the economy, demand decreases, we get a recession. Right. We haven't seen signs of that yet. We've seen unemployment tick up a little bit, but so far consumer spending is also still pretty good. Like, we haven't seen it meaningfully drop. Right. GDP was lower but healthy. So it's kind of like they're on maybe the edge of where they need to be, and I think that's the game they're playing right now in terms of trying to figure out when that first rate drop can happen without setting off some kind of inflationary event, which it seems low now. I think we're going to get that drop November, December.
So going back into any of the questions, was there anything else that we should cover from our viewer questions?
Yeah, so we had another question about student loan debt. Is student loan debt forgiveness really going to improve the home buying potential of Gen Z and millennials that carry the majority of the student debt?
Right, which is also a huge portion of our population that should be buying homes right now.
Right. The short answer is yes, right? That should be fairly obvious in the sense that, their debt to income ratio is immediately improved for those of them that do get some loan forgiveness.
Right.
But also their ability to save over time is improved, right? Because now, the average, I think, is about $350 a month. That's money that, like, some portion of that can be saved depending on their financial situation. Their ability to save certainly improves. For the housing market, this is more of a long game kind of situation, right? Like, it's probably not going to push a ton of them into the housing market over the next couple of years. Interest rates are still high.
Sure.
The effects of having that debt are still been there for, some amount of time. They need to save. Home prices have come up a lot. Right. But it does put them in a better position to eventually do that. It's going to, kind of reduce the amount they've had to delay that decision for a lot of those people. Anything that increases demand for us is a good thing.
Always a good thing.
The challenge will be, we need the supply, right? Yep. Hopefully we're going to get it. We'll see kind of where things shake out.
Yeah, absolutely. So I love this conversation. And as you said, it's a bumpy road, it's a journey. And we hope that you all continue the journey with us. Don't forget to hit subscribe so you don't miss a minute of the upcoming market snapshots, because you will want to go on this journey with us. We'll take you through the numbers every single month and ensure that you know best about how to have conversations in your real estate environment about whether to buy, sell, or invest in real estate. And we hope to see you next time.